Growth amid shifting tides. That's the story for equities as we head into 2026. Despite uncertainties, opportunities are emerging across regions and sectors. Investors are asking, where should we lean in and what risks should we watch?
And that's exactly what we'll explore today. Today, we'll unpack what's shaping the regional equity outlook for 2026 and how investors can position themselves ahead.
Let's start with the big picture. We maintain a constructive stance on equities in 2026, supported by a relatively benign backdrop. Central banks globally are expected to maintain a broad-based easing cycle, which should underpin liquidity and sentiment. This is especially so against a non-recessionary backdrop, which tends to be constructive for equities.
That's right. While the macro environment looks supportive, market concentration remains a key theme. Quality growth stocks have dominated in the US, but if AI expectations disappoint, we could see a sharp rotation into low volatility strategies. This makes diversification and selectivity more important than ever.
Indeed, Kim Ling, it would not be surprising to see a reality check in the AI space, but we see this as a healthy reality check because the AI theme is a secular one which is fundamentally sound over the long term. Ultimately, we see compelling opportunities for investors who adopt a balanced approach, combining exposure to the secular AI theme via the IT and communication services sectors with diversification into others such as the utilities and material sectors.
Great, Pei Han. How about our regional equity preferences? Can you share with us which are the areas that we like?
Regionally, Asia ex-Japan stands out. We have an overweight stance on Asia ex-Japan equities given the region's more favorable risk-reward profile relative to peers. Fundamentals are strong, and potential Fed rate cuts would also result in easing of financial and liquidity conditions as well as a weak USD. These have historically benefited Asia ex-Japan equities, and as mega forces reshape economies and financial markets, we see Asia contributing significantly to this transformation and offering many opportunities for equity investors. These include the areas of AI and robotics, advanced manufacturing, and metals and mining, which is experiencing a resurgence with the transition to green energy, electrification, and infrastructure development. These are just but a few of the areas that Asia has to offer. That said, there are idiosyncratic factors that we need to be mindful of, such as geopolitical uncertainties and social unrest in certain countries.
And don't forget China and Hong Kong, which account for the bulk of the MSCI Asia ex-Japan Index. We believe that the rally in China's equity market has more legs as valuations remain undemanding relative to history and global peers, although investors will still need to practice selectivity and disciplined risk management.
Indeed, Kim Ling. Besides China and Hong Kong equities, we also favor Singapore and Malaysia equities in Asia ex-Japan. Singapore's economy remains a beacon of stability in a world full of uncertainty, and its market-friendly policies should channel capital more widely across sectors, while companies are hinged to positive structural trends.
We are also constructive on Malaysia equities, supported by key fiscal reforms, FDI inflows to data centers, growth from the Johor-Singapore Special Economic Zone, and undemanding valuations.
So what's the takeaway? Opportunities are out there, but navigating shifting tides requires agility and insight. Stay diversified, lean into regions and sectors with structural growth drivers.
Thanks for joining us. I am Kim Ling.
And I am Pei Han, and this is Bank of Singapore CIO Investment Institute.
For more information, please refer to Outlook 2026 publication.